You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 23rd of November 2022, and I'm joined by our special guest today, James from Quality Compound. He has been on the show twice, well, he's been on the show once before, but was it twice? It was definitely two interviews. I can't remember whether it was recorded as one or two. But he has been on before. It was under the name 20s Trader at that point. If you do want to go back and listen to them, it's episodes 62 and 64. James, firstly, thank you very much for coming back on the show. And for anyone who hasn't listened to you before, would you be able to briefly summarise just who you are and your investing story to date?
Well, hello, Sam. Thanks very much for having me back on the show. Delighted to be here. So it's been about 18 months since our last episode, so fantastic to be back. To answer your question, I'm essentially a private investor who's gone through probably 8 to 10 years now of investing in the UK and international markets. And towards the kind of latter part of that time period, journaling and writing and eventually freelancing for a publication with my writing. So I can tell you a bit about that journey today. But essentially, I'm a quality-oriented investor who, is having a lot of fun kind of writing and meeting people in the investment community as I go along, really. I think that's probably the best explanation I can give.
Do you still have the paid service on the website?
So, yeah, I can kind of take you through the journey that we've been on over the last 18 months or so. So when I last spoke to you, I was, going under the name The 20s Trader, and now it's switched to the Quality Compound. So I think there's a few things that have gone on during that time. Back when I last spoke to you, I was, working at the time of COVID, but I had a lot of spare time during the COVID pandemic, and I spun up a website which I called The 20s Trader and was writing blogs on. I think I was doing at least one kind of free content piece a week, and then a paid subscription piece through the Patreon service, and then, quarterly newsletters through that Patreon service as well. So I was pumping out quite a lot of content. And then, slowly across the course of the year, I think my personal life and work ramped up, and the ability to commit to the paid service was diminished. And so sadly, I had to shut that part down because it became sort of writing on both Saturday and Sunday. It's a lot of time of your life that you put on hold. And so as the lockdown started to ease, I kind of wanted to do more life things rather than, investing and writing all the time. So that kind of paid service shut down. And then probably 6 months after that, I was still doing writing for the website on a free basis. But I ended up picking up a freelance contract for a publication called The Armchair Trader, which I've been writing for probably 3 or 4 months now. And that's really kind of turned things around for me, where I'm able to write a kind of semi-weekly post through their publication and get remunerated for it. So at the moment, that's where I've kind of focused my efforts. And I think the Quality Compound website is still there and all the content's up, and I will be occasionally posting on it. But I think for now, it's kind of gone to the focus where it's that work-life balance, I think. And that's the journey I've gone on, really.
Do you mind if I ask how Armchair Trader came about, and then also what kind of stuff you're writing for it? Like, what would a typical article be about? Is it just covering earnings, or is it deep dives?
Yeah, so Armchair Trader, I'd only heard of them a couple of times before I actually met, but I was at the investor show in London, one of the London investor shows that gets put on in physical form. And I think it was one of the first times they'd kind of come back face to face after COVID in Islington. It was a really good show. And there was Stephen Yu from Blue Whale Capital was there, Harry Nimmo, which is a well-established fund manager in the small cap space, and various other UK-oriented managers to go and do talks about their investment style and what their opportunities are. I think JP Morgan were there too from their asset management vehicle. So you turn up to watch those talks, but there was also a big exhibition side of the room, and the armchair trader guys were there, and I introduced myself to them. Michael, who's one of the editors there, and we just kind of hit it off and built a connection. And I showed him my website and showed him some of the work that I was doing, and kind of went from there really. And we just kind of built a relationship and pitched a couple of articles to him, and then the rest is history. So my actual kind of remit on their page is to kind of stick to what I know, so to speak, where most kind of financial writers for a freelance basis, have a background in journalism and not in the investment side of things, whereas I was coming the other way around. So they like to kind of leave me to it, so to speak, in terms of what I want to talk about. So it's a lot of the content that I would have, published on the Quality Compound. So I'm keeping the integrity there on, speaking about good quality companies that I like the look of, and I kind of get to go and do around 1,000 words on why I think things are happening, and just stretch a little bit further than just the earnings. So maybe they've done recent acquisitions and how the cash flow has been impacted by them, or profitability and things like that. So digging a little deeper than your typical article would, and it kind of gives that midpoint of giving that quality to the publication. So that's been that for the last couple of months.
Well, what proportion of the articles then are on stocks you already own versus stocks you don't? Do you just tend to find that as you're reporting on your own businesses or looking at them, that just tends to be the focus, or is it, right, I want to go have a look at this week?
Yeah, that's a good question. I'd probably say I started by doing a kind of a global view, and as a lot of my holdings are in the US, it was quite a high proportion of the stuff I'd already owned, so maybe 60%, something like that. But since then, they've kind of given me the prerogative of focusing on the UK. So I'd probably say something like 60 to 70% of the companies I'm writing on, I follow. They're probably in my investment universe, but I don't have a holding in them, which is really nice because it then kind of allows me to kind of keep up on them and, just try and understand what they're doing. So I think the selection process will be, midway through the week. I'll kind of try and have a look at what RNSs have been put out for that week and who's reported, and then kind of go from there on selecting what I think would make the most interesting article.
So going back to Quality Compound, why did you change the name? Because it was 20s Trader last time we spoke.
That really came about from, I think, you set a name for yourself, and then you can kind of feel a little bit uneasy with it over time. So, coming into this, setting up with the website and everything like that, it was a really quick decision as to, okay, I've been investing for years, COVID's hit, everyone, all of my friends are asking me, and I explained this in the first episode, where I'm getting, asked by friends, consistently to give them hints and advices to setting up and investing and things like that. And so myself and my partner kind of really thought, hey, we better do something with this, because I'm constantly, talking about things with my friends, and I should really be, publishing something or, making some use of it. So we kind of within a week had decided what the website would look like, what the name would be, and all that sort of stuff. And then I think over the months and months, I was writing for about a year under that name, and then thought, oh, I'm not really sure how this is sitting with me. I'm more of an investor than a trader, probably am more leaning towards the quality companies. And even like now, as we go on, I've got less time in my life to be searching for trading opportunities, and I've got, more interest in looking for something that I can hold on to for a long period of time, almost a set and forget rather than a constantly monitor. So I think that's really where that name change came about from.
I do actually prefer the new name. I was actually surprised when you changed it. I was surprised it was available, but on the Twitter handle. How's so we've done the personal side, but how's the portfolio done? and changed in the last 18 months, if at all?
Yeah, so I've got, in terms of structurally, the kind of the names and results, but then, overall performance as well. So I think to kind of be descriptive about overall performance, I'd probably say the personal portfolio took a hit sooner than the market did in terms of coming down in value. So I think we were ahead of the market in that decline. But then actually the last few months has seen a kind of a much quicker pickup than the market has been, for a couple of reasons. So I think I probably am in line with the market in total kind of performance, but there was that kind of quicker step down and then almost a quicker step up for a couple of reasons. So I hope that kind of gives you a picture of performance without going too much into the numbers. And then I think, talking actually company specific wise, there have been a few changes that I can take you through. So I've got a list. So yeah, the main kind of changes that we've actually had in the portfolio, the personal portfolio over the last year and a half, been the sale of AB Dynamics, which is the suspension and track testing company in England. Wingstop I sold, which is the chicken wing franchise company. Strix Group, which is the kettle controls company. Remy Cointreau, which is the expensive brandy and spirits company. And GB Group, which is a kind of a roll-up vehicle in identity and fraud technology solutions. So they've kind of been exited throughout time over the last year and a half. And then we've built positions and added to Safe Store, which is a completely new position. MedPace, which is a completely new position that I'll go on to talk about. And then we've kind of topped up JD Sports, Gamma Communications, and Games Workshop.
Could you briefly talk about why you sold Wingstop? Because I've just picked it out sort of at random, but I think we talked about it in our last interview. So I'd just be quite curious. And then just going across the ones you've sold, is there any theme to what you have sold? Is it because you wanted to add to something else? Is it because you just got it wrong? Is it because the thesis changed? What do you think the reasons were for those sales?
Yeah, these are important questions. So Wingstop I'd held for probably about 2 years before kind of coming on to the podcast, and essentially it's a fantastic company that has so much opportunity, but it's one of these companies that if you actually look at the chart, it did this massive, probably 40 or 50%, dip from the highs well before the market dropped, which is essentially what I was talking about. I think there was a quality, sell off, maybe a month before the rest of the market kind of bottomed out. But Wingstop, if you look at the chart, it did this U-shaped pattern where it kind of gapped up about 100%, pretty quickly. So now you're sat on a stock that, has rallied really strongly versus the rest of the market that's tanked. And, whilst it's a good company, I think it was trading on something like 116 times earnings by the time it had, galloped back up. And there are reasons why, this company is trading at such a high price to earnings ratio. And I can go into it a little bit, but this sort of franchise, essentially how these franchises work is in their earlier stages, if there's a proof of concept, they've got 1,800 stores at the moment. The earnings flow from that is minimal, but you can see that they've got all the right numbers in terms of operating margin. The actual stores are generating revenue. They're the number one franchise request in America. So they're going to do about 6,000 to 7,000 units. So that's almost pretty much baked in. But where the kind of earnings can be really expanded in these sorts of franchise things is if you look at Domino's, what they did over the period of low interest rates, they're 5 or 6x leverage to EBITDA. So what they do every year, they buy back something like 10 to 14% of their market cap. If you look at the shares in issue for Domino's Pizza Inc., that's the US franchise owner, the shares in issue just crater down every year. So they're doing that by artificially kind of jacking up the leverage. And that's what Wingstop is yet to do. So whilst it might be trading on a crazy multiple now, you can really see that earnings flow coming up both through adding stores and by leveraging, because they've got such a consistent royalty coming from their franchisees. So that's why I liked it. But at the same time, you've got this juxtaposition with a market that's tanked and a stock that's done really well. So had to cut that one. Rémy Cointreau is much the same. You're looking at a business that's fantastic. It's got incredible pricing power. I think it can sell a bottle of its high-end spirit for £100,000. No one's really going to care at that price bracket if you add an extra 10% on. So it's got inflation-beating power. But again, you're looking at a business that has done a lot better than the market, where there's other things that I think are more cyclical that could have a quicker bounce back that I added to. GB Group was sold at its highs. I think I was up about 60% on that, and just thought, take the money off the table, because one of my articles goes into this. Actually, it's on my website, but they're a roll-up vehicle. But unfortunately, a lot of good roll-up vehicles will spend using their own cash flow, which is what Gamma Communications does. I think you either own Gamma or you're very into the story there. So
no, I'm a very happy owner of Gamma.
Yeah. So they'll use their free cash flow to buy, 40 million of another business every year. But GB Group does, a placing, and I think I looked in one of my articles around a 5-year period, saw 80% of its market cap in shares being added to the market. And it did very well for a long time, but I thought, it's only going to be a matter of time before another big placing comes on and dilutes you down. And a matter of fact, within about a month of me selling, quite luckily, they announced the acquisition of Accurant, which is a US identity solution provider that they, were spending $900 million on, and it's crashed the share price ever since. So did well to get out that one. And then AB Dynamics, which is a UK business. This is an interesting conversation. Maybe you've got some insight here, but this is one of the decisions that I've made, and it's a bit of something that I look for as criteria now, that when you actually look at AB Dynamics as a company, its margins are great, and for years and years, its kind of net profit has been going in the right direction, with sales. But if you actually look at what you're getting for the 300 to 500 million market cap, you're looking at something like 10 million in net profit. And it's just, if you look at the numbers every year, that real bottom line, it's not compelling. And I think to a certain extent, you've got these companies that run into this spot a bit like there's a company called Bioventix, and Bioventix has an operating margin of 80%. It's one of the most profitable companies probably in the world, but definitely the UK, and investors love it in the UK. But it's got a 300 million market cap, but its net profits are so tiny that you sort of think, how does this snowball ever get rolling? Versus a company that, it might have a bit higher market cap, but it's kind of got a bit more momentum behind it because the numbers are a bit higher, whilst the margins are like 16, 17% on the operating side. I just didn't think it was compelling enough to carry on holding when there wasn't that momentum coming through the bottom line. So
what was the revenue growth like?
It faltered in COVID because it's a track testing provider. Yeah. So essentially all the tracks had to shut, which was a knock. But I held through that period because I knew that was coming back, and then the shares bounced back. So, the top line probably grew 20%, after, compared to 2019. So looking at the 2019 comparative in 2021. So, the top line wasn't that bad. And even the EBITDA and adjusted operating profit isn't that bad, but it's just, you're looking at very small numbers when you're looking at net profit. And I just, there's something that says to me, just go on the larger sort of side of the company. So, maybe that'll turn out to be a wrong decision, but it's just what I was thinking at the time.
I don't know. I think with those ones, what one thing I've found recently is I find that like when I'm doing, say, a 10-minute overview for a company, for example, for the podcast, there's a few things I'll check with every company. And then if it's actually quite enticing, I'll be like, right, well, I actually want to look into this a bit deeper. But one of the things I always check is I'll just look at the figures for the past 5 years. And what I'm getting now is you've got, for example, like I wouldn't have looked at it anyway because of the industry, but we'd recorded an episode last night and we looked at Young & Co.'s, the pub chain. And Young & Co.'s, they've basically got 3 lost years because of COVID. So you look at the 5-year figures and they've hardly moved. And for me, that's the end of I'm not going to go and look at 10 because I wouldn't do it anyway for a pub chain. But it is difficult because with that, I mean, for a pub chain, I thought it was quite pricey. It was about 19 times earnings or something. But there could be a growth story there, but I wouldn't have picked up on it because I'm looking at the 5-year figures and they're not there. So I'm just stopping. Whereas over 10 years, I don't know, they might have done a bit better. But I think with the smaller figures, I don't mind it so much as long as you can see where the growth comes from.
Yeah, so this I just pulled it up on my market screen here, and you've got from 2019, you've got net sales have basically stayed at around 60 million, 2019, 2020, and 2021. It's only in 2022, and they've hit 80 million. Net income was 8 million in 2019, and in 2022 it was 4 million. So you've done 4 years of revenue at 60 million on average, or 65 million, let's say. So you're looking at 240 million of revenue over a 4-year period, and not more than 15 million of net income over that time. And you just think, what are you going to do with that? Where's that going to get you?
Where do you find these businesses? Because they're not small caps, but they're not FTSE 350 either. So are these just AIM-listed companies? And how are you finding them in the first place?
Yeah, I think I talked a little about this on my last one, so that there'll be a few insights there. But I use quite a wide variety of sources to kind of find things. I think over the years I've got quite a good repertoire of what's in the AIM 100 and what's in the FTSE 250. Tend not to be so bothered about the FTSE 100, but I have kind of scoured A to Z through those indexes to get a grip of what's in them. So that's a kind of a place to start. I'll also look at there's a FTSE sector tool. You could just type it into Google, and so you can click into a sector. So comes out, after 10 years, you've sort of gone through all market cycles. So if a market cycle is looking at, I don't know, defense is looking good, you'll go into that sector and analyze all the companies in it and just get a quick, frame of mind. So there's those things. And then I use a tool, which I found not so long ago, which is called marketscreener.com. And that's really good for identifying either international or UK companies. You can kind of click on and scroll through their look functions and literally go by sector, or if there's a company that you like, you can click on a company breakdown, scroll down, and that will give you all of the similar companies. So that's really useful in terms of, okay, if you like something in like architectural design, like Autodesk, which is the US software company, you can click on that, and then it will give you, Nemetz Czech, which is the European version. It'll give you ANSYS, which is the environmental simulator. So it will give you a list of all of the other ones, and then you'll get also a percentage year-to-date change. So you might see, one's done a lot better than another. There'll be a story in there, but you can kind of quickly click and see, who's got the best margins, who's got the best growth. So that's a tool that I really like kind of bouncing around with. And then the other one is I follow, like yourself, I follow a lot of kind of good quality funds. One of the best probably in the UK for kind of FTSE all-share companies, so either AIM 100 or just above that, is Sanford DeLand, a guy called Keith Ashworth-Lord. He runs a Buffettology fund, so it's in the name, right? He's looking for companies that are, have a good moat. They've got good operating margins. They've got growth thrown in there too. So he's looking for some of the same things that I'm looking for. So if you were to look at Buffettology, I think he owns AB Dynamics, which we were just talking about. He owns a company called Craneware, which is a really good software business. It does hospital billing software. He owns Darktrace. He owns a lot of stuff that's in the investment universe that I kind of look for. So I'll look at that, listen to him on a couple of podcasts. You can catch an extra few companies. And then internationally, if we're talking US, there's obviously Fundsmith, which has a Smithson fund. So I look through their annual report. Actually, if you have Hargreaves Lansdown, you have the app. It's the easiest way to find out what a company holds is you just kind of go on the investment trust or the fund and click annual report, and it'll pop up, and you'll be able to scroll down to all their holdings. So you can see, what companies they've sort of bought and sold recently, which is always good to look up. There's a company that I really like, an investment fund in the US called Poland Capital. And they do about 5 different fund vehicles, which is all the way from global growth to small cap US companies. And I found some real good companies, of which we'll talk about one later, which is MedPace, through there. So a couple of different things. I try not to look at things on Twitter or, what people are overly pitching to you. It's better to do your own research and come to a kind of a conclusion through organic thought rather than someone telling you to do something.
So where you've got that mix of UK and international stocks in the portfolio, what do you think about investing in the UK versus the US and other countries? And what do you think of the valuations as well? And do you think that's changed since you were last on the show?
Yeah, I think when I was last on the show, the US market was doing very well. The UK seemed to kind of been a bit of a dog for a long time. However, with the old oil and gas and defense companies and pharmaceuticals and things like that, at least the FTSE 100 has been doing better recently. I guess my view is, I think I almost feel as though the fact that we are all UK investors, hasn't done us any favors in terms of we've got a kind of an orientation or a safety perception around British companies that we know them better and, they can perform better for us. And there's that comfort feeling of, if you've got an extra place that needs filling in your portfolio, if you're based in the UK, you're probably going to look, for a UK company first up. But, I wanted to talk about this because I think there are a few interesting things that I've read over the last, few months or so. But either Europe or the US, if you're to listen to some US podcasts, there's one that I like called The Compound Show, and you can understand from their perspective just how much they do not want to invest anywhere else, right? There's a guy called Josh Brown, and he explained European companies. He said in the US, he had an antitrust lawyer on. So a guy that was talking about the size of, companies and how big they're able to get to. And the antitrust lawyer was essentially saying, look, in America, size does not matter. It's only when you break the rules do we come looking for you. So you could grow to $50 trillion market cap. That's not a problem. It's only when you abuse your position as a big player in the market. But he was flipping it onto, the European market, where essentially we strangle companies that get too big for reasons that as citizens make sense. I when I look at what's happening in China, where you have, the Alibaba situation and the crackdown, and, as citizens of a country, I think it makes a lot of sense to regulate how big companies get, who they're allowed to buy, and, all these sorts of things. But, from an investment standpoint, you want the best return. And I think, the US is where size is encouraged. And there are a whole different kind of small little things that kind of add up. So I was looking at an article about Linde, the French conglomerate in the air and gas business. They make helium and all sorts of different industrial gases, and they merged with a company called Praxair, which is a US company, probably a year and a half ago. But they're basically listed on the French stock exchange, and they've now made the decision that despite being a French headquartered company, they've got so much heritage in France, they're going to get rid of their French listing and list over in New York, for the main reason that the French regulation is, as soon as you get to a certain size as a constituent in their main stock market, they want investors to force sell to get you down to the right weighting that you should be. So this creates constant pressure, selling pressure on the shares to essentially bring them back in line with the market, right? So it's almost like an anti-growth, prospect. So that's
how does that work in practice?
So essentially, if you're Linde and you're on the French stock exchange and your shares go on a run, and so they pop 20% or something like that, and now it distorts the valuation, and you become over the threshold of where the French regulation is, the institutions will have to sell that stock to bring it down in value.
So would they say what? Well, this company can only make up a maximum of X% of the total market cap.
Exactly.
And you just you wouldn't get, for example, I know it's a tiny company, but you wouldn't get a GameStop situation where something's been run up to a level where you've 10 extra money overnight.
Yeah.
How I know you're not an expert on French investments, but how does that, is that adjusted as a company grows? How do they actually, because you'd have to monitor that, because if the company's just getting better and better.
This is exactly why they've moved to a New York listing. There's an FT article, right? If you type into Google, Linde delists from CAC 40 France, for New York Stock Exchange, I'm sure the FT article will pop up. But essentially, it's a backwards. This is not a growth orientated thing, but we don't know this. It's not written on the stock market guidance, so it's not there for people to know until you see something like this and you go, well, why the hell was I thinking I was going to get an outsized return from a French equity when there's these rules and regulations in place? So that's one thing. And then on the side of the US, they've just got a different mentality. And I was talking to someone recently that a lot of companies, well, pretty much the legal limit for annual leave is 10 days, versus probably 25 here. You've got just different conditions for life there. Capitalism is the center of everything they do. And I don't want to live there. I don't think these things, the way that their economy is set up, is great for lifestyle. But, where would I rather put my money to work? That to me makes a lot of sense. And I think the UK, it's not a, it's very obvious that the UK has had a lot of problems recently. Even in politics, they're trying to turn around the UK market, all the time, because you've just got this kind of flow of capital. All the IPOs go to the US. So, London hasn't done very well in terms of, attracting capital after Brexit and things like that. So I think the likelihood of you getting, a good company and an outsized return in the UK is a lot lower than the US, in my opinion. I think, that really says it all and should be a guide for people as to where to allocate.
Do you think your portfolio reflects that?
I was looking the other day. I think I'm 60% US and probably 30% UK, 10% other markets. So probably not enough. I think the only thing that we do contend with is the pound dollar situation, which, over the last couple of months, I probably wanted to add more to a US holding, but at, £1.05 to the dollar or 1.10, that it's been lingering at, it didn't really seem that appealing. And that's helped because, we've seen that the pound has popped back up. So that would have only been damaging. So that was where I've been topping up JD Sports and Gamma Communications and Games
so
Workshop.
Do you not think the lower valuations is enough to offset, call it, the better conditions for growing as a company in the US?
Yes, I agree, but I viewed this pound as a situation that essentially would snap back sooner than valuations would in the US. I think.
No, sorry, I meant, do you think the lower valuations in the UK compared to the US are enough to offset the fact that, although you are paying more in the US, you're paying more in the US. Sorry, although you're getting these better companies in better conditions, you do have to pay up for it.
Yeah, I don't think that matters. I'll tell you for why. Essentially, there's a handful of companies in my portfolio that I think, over the next 10 years will do extremely well. And we could talk about one, which is Axon Enterprise, that I've been talking about for a long time, at least on my Patreon blog and here, there, and everywhere, really. This is a company that is essentially going to transform an entire sector and, has the power to. And I think I've witnessed in my industry where a software product comes along and completely transforms everything. And that product I'm going to talk about is Viva Systems. You might have heard of it. It's a SaaS software solution for the pharmaceutical industry. They essentially cover, document management, CRM solutions, across the whole board, from not only the commercial side of the business, but regulatory side of the business too. And essentially, when you have a highly regulated industry or something that is a very complex industry that hasn't been digitized, when someone comes along that's well resourced and has the vision to go and digitize that industry, they can do amazing things, which is where you've seen the growth of Viva. I think Axon as a company is going to do that in law enforcement. And, we know how complex, especially US law enforcement is in terms of the judicial system, on the street law enforcement. Imagine where you have a system that is so still, stuck in the past in terms of most of the things that happen get written on paper. Nothing has changed in the legal system really for hundreds of years. People are still, the process is still the same. And now you've got this company, Axon, who started with this taser business. They own the patent behind the taser gun. And then they moved into body cameras, and now they're moving into, a SaaS workflow to manage the whole process. So storing the evidence, they're going to help you file a police report, and then that report gets saved in the cloud and can be used by lawyers, and other evidence sources can be used. Identification systems, so a police officer can, look at an ID card with a Axon body cam and it can give all the data in real time. This company is going to completely transform a whole industry. And I don't think you've got anything like that in the UK, because I don't think the capital, the resource pool to go and do something like that is just not there. Try list that on the London stock market, see what happens. Probably won't do too well. So when you're looking at your portfolio and thinking, okay, what names do I have in there? What's really going to be able to take me from, okay, my life's comfortable, but, actually adding some serious value to your portfolio. Those sorts of companies, I just can't find any in the UK, really.
So why do you have the 40% UK at all, or 30%? Why not just sell it and just go, or is that something that you think you probably will do over the next few years? And why hold any UK companies if all the best companies are in the US?
Yeah, that's a really good question. I think there's a diversification piece there for me. So there's that. There's also the currency piece, which we've talked about, that, you know, throughout periods of time, you're going to be a little bit offside on the currency. So I think there's that. There's also a process of, you know, some of the companies that I've got, I think, are probably either up there or, you know, good enough. So, you know, I think Games Workshop's probably 10% of my portfolio. So when I say the 40%, you know, I think Games Workshop's probably up there in the best of the companies that you can find. So I agree with that questioning. I think it's just, you got to be super selective, you know, if you are in the UK, and also just consider what you're missing out by choosing to just completely ignore a market like the US. That's more of the message.
So I've got it on my list to discuss anyway. Seeing as you've brought it up, why do you like Games Workshop so much? I should disclose, and this is going to be the case for a number of the companies we're going to talk about. I am biased, so I think Games Workshop is my third largest position. So I do like it a lot. But why do you think it is that good that you would hold it instead of another US company?
Great question. I think we went through a bit of this on the last podcast, and I think, you know, there are probably quite a few Games Workshop fans listening to your podcast, so I'm not going to go into too many of the details as to the basics of the business, but essentially you've got a business focused on one thing, right, which is producing these miniature figures that people love so much. Then you've got this kind of side business in the kind of content and IP that it's leveraging. So that's the kind of, you've got this machine or engine chugging out returns, which is your, you know, your miniatures business, which is super high margin. You know, you're looking at, it's like an IKEA model, right? It's like, you know, sell someone a table and get them to fit it at home. So, you know, you're selling someone a piece of plastic essentially, and you're getting them to finish it, paint it, you know, take photos of it, put it on Instagram and market it. You know, you're getting the whole package done for you, but that's the art of the you know, miniatures business. So you got this incredible miniatures business, which does really good, you know, return on capital. It's alone, it's worth investing in. But then this IP on the side, where you've got years and years and years of a company that has done books and, you know, even into TV shows. It's got its own Warhammer Plus, you know, content that it's churning out. So you've got a rich set of IP that it's kind of, over the last 3 or 4 years, really started to leverage. One of my friends, actually, that we speak a lot about investing, he actually plays the Total War Warhammer franchise games, which are actually a smash hit. So you can look on Steam and the rankings, you know, that's usually when it comes out, it stays as number one for a long time. So, you know, they've got some really good games, and, you know, they're not afraid to kind of protect their IP, and so much that actually I read a story that when Activision Blizzard, the company Blizzard behind the game, you're going to have to help me, Sam, I think it's World of Witchcraft, something like that. I think that they actually went to Games Workshop to try and leverage their IP, but Games Workshop were worried that it would tarnish the IP in the first place. So, you know,
it's World of Warcraft, would it be?
World of Warcraft, yeah, that's the one. So that was a smash hit, and arguably they made the wrong decision there. But, you know, they are very protective of what they do and want to kind of retain the value.
As an offshoot, because it sort of links to this, what do you think of them restricting the ability of, like, say, the superfans to post content on YouTube?
I think that's noise. I think it's a side show. I think, you know, around the time they did that, so much was posted about how, you know, how it's a terrible thing and how there's boycotts and things like that. And, you know, the numbers didn't change. You know, they did absolutely fine. I can't imagine that having a massive impact on the end business. So, but, you know, actually back to the business itself, if you read a annual report from Games Workshop, it reads like a Berkshire Hathaway, report. They are incredibly into, managing the business as a steward and really not caring too much about what investors think and just focusing on the business. And that shows then in their numbers. They're paying quite a decent dividend now. Lots of special ones come through. They've got a return on capital employed that's frequently above 60% and operating margins that are above 20% too. So it's, this is a business that has carried on performing throughout COVID. It's held on to its revenue, which is good to see. But, there was criticism to say that this was going to just be a bump, a bumper year, and then, people would go outdoors. But, geeks don't go outdoors.
No, you made the joke rooms before I could there.
Yeah. So there's that kind of perception, I guess. But all in all, good company.
So, seeing as we've sort of hinted it a bit in that, well, you talked about Games Workshop being the stewards of the business. What do you think about capital allocation in the COVID era and the lessons we can take from it? So, for example, one thing I'd use as an example is we've seen a lot of US buybacks that in hindsight were at very, very high prices, which I don't think is necessarily, it's easy to say in hindsight, but some of the capital allocation we've seen, I don't think has been fantastic.
Yeah, I agree with you. I think my thoughts on capital allocation, I was just thinking about capital allocations. We were talking about Games Workshop there, and the beauty as to what they've done, which is essentially throughout COVID, nothing. They've focused on the business, and I think I agree with you on the buybacks, but my main focus for capital allocation over the period and the lessons from it has been acquisitions, or where they've spent on the business, doing the wrong things. And there's a few examples from that. But I think the kind of the premise of this point is really interesting, because for many years we've lived as investors through periods of time that are relatively stable and companies doing sensible things. And then this kind of whipsaw action of COVID and all of the stimulus and the low rates and, the phenomenons like the GameStops and, different businesses and industries going parabolic because demand was there. You've had some real strange undulations in demand for different goods and services. So you've just had this incredible period of change, condensed into such a short space of time that's now almost like a great bank of information for you to look back on and go, okay, how did my company allocate capital during this period? And your point's very valid around buybacks, right? Where companies have been buying back stock at incredibly high rates. But actually, when you look at the businesses and where they've been allocating capital in day-to-day operations, I think that's a really easy way to then kind of take a look at your business from there. So I've got a few in mind that, one I talked about earlier, which was GB Group. This is a company that is a capital allocator in terms of M&A. It's done M&A for years, but, during this kind of COVID period, it goes and does the largest M&A, transaction of its entire lifetime at something like $900 million, buying a company which has got inflated revenues because Acuant does all of the cryptocurrency, transaction, which was booming in that period. So you've got a company that was just way too quick to pull the trigger on something and get a deal done. On the operational side, I found a really interesting story around Zillow, which is the US equivalent to Rightmove. And so this is a company that's in the sweet spot during COVID. It's got everything going for it. Everyone's on Zillow trying to buy a new house and move up the ladder and spending more time on the platform, as they did with Rightmove. So what did Rightmove do during the 2020 kind of period? They did nothing. They actually went out and reduced their fees to real estate agents in the UK, gave them a 3-month sort of period of not charging any fees, and then slowly kind of gave that back, but they focused on the business. Zillow, on the other hand, the US company, started doing a whole new business unit called home flipping, where they started buying houses in the US to list them on their platform to sale. So going from, classified ads portal to real estate flipper investor or something, and it completely crashed the business. So, that's another one. You got things like Meta doing the metaverse, one down here recently, 888 choosing to buy William Hill, the European or UK operations. And there was just some news out today that it's secured debt to do that transaction at an 11% interest rate. How on earth they're going to make that deal work is beyond me and the people that I talk to on that. So
maybe they're banking on 20% inflation.
Exactly. So you're thinking, who's running these companies doing these sorts of deals? And more importantly, what you should be looking for is what consultancy is telling them, that these deals are going to work out. But, importantly, this is a period that you can look back on, your portfolio companies and try and understand why they've done what they've done. And hopefully you haven't encountered too many of these capital allocation situations. But that's a few kind of lessons that I've got there.
I think mine have all been quite well behaved.
Yeah.
The only one that would get across for that would probably be Etsy. So Etsy went out and bought, probably at the height of the pandemic, it bought E111, and then it bought, which is like Depop, the Brazilian Etsy, and it bought Depop as well. Now Depop, I love both the acquisitions. I think they make a lot of sense. I think they're great add-ons. I'd actually looked at whether or not Depop was listed previously. So I was very pleased when Etsy bought it, because it's a business I wanted to get my hands on anyway. But in hindsight, they did overpay. And I think they've since written that down on the balance sheet as well. The only thing I'd say in their favour is I think they bought it with stock, and Etsy's own stock was overpriced at the time. So it's not ideal, but it does soften the blow a bit. But then both of those, they were small acquisitions and they were add-ons. So neither of them were deal breakers. So they weren't fantastic. I think they were good acquisitions. The problem is they overpaid. Yeah.
I think at least they were in the same line of business.
Yeah.
That Etsy is in, right? And there's a lot to be said for that. When you've got, Bayer, a pharmaceutical company, buying Monsanto, which is a seeds business. I don't know how companies do this continuously, but it just brings disaster. Like Avon Rubber buying a ballistics protection business that goes on to fail all the tests and blow up the stock. It's just that you don't know where they find them or how they get these ideas, but you've got to stay in your same vertical in M&A, and if you're seeing a company doing something completely different, it just doesn't make any sense.
I think one that's on the opposite side that I think is quite a good example of what I'd consider. Well, it's quite a good one because it's incredibly poor capital allocation, but for both businesses. So Haleon.
Yes.
Yeah. So that when that was part of GSK, when Unilever came in and offered 50 billion for it, I think at the time the Unilever management was getting a lot of flack for not doing a good job, quite rightly. I think, to me, it just seems like they panicked and just thought, well, we've got to go out and do something to appease shareholders. They offered massively more than what this business was worth. I think it's got some decent brands, but I don't think the brands are as good as Unilever's. I think if the acquisition had gone through, I think the brand quality would have been dilutive, albeit not by very much. And they offered 50 billion for this business, and for some reason, Glaxo rejected it. And then they've since spun it off, and they got half the amount for it. I don't know who was actually making the worst decision there. It's Unilever for trying or Glaxo for declining, but that's probably the worst one I've seen, actually, because that's just a shambles on both sides.
It's awful, but the only thing that I can think of was actually when they spun off Haleon, they added 10 billion to its balance sheet in debt, which is what you got to look out for in spin-offs sometimes, that the parent company leverages that thing up and then spins it off. And so I'm not sure what the total enterprise value that they kind of got away with. Maybe the market cap was half, but they might have kind of had the last laugh there with a bit of debt on top.
But even if you had 10 billion onto, they're still 15 billion short.
Yeah, probably not the offer from Unilever.
No. Anyway, so speaking of debt, interest rates have moved, or actually started moving upwards since our last conversation. How has that affected you and your portfolio, if at all?
So it's essentially, interest rates have a two-way kind of two-pronged effect on a portfolio, in terms of you've got the immediate effect on pricing, where you have, a discounted rate to future earnings due to inflation and the impact of interest rates. You've then got, that's going to get baked into the financials, and then, share prices will come down as a kind of a forecast of that. That's the kind of short-term headwind or impact, as you'd imagine. But then the actual business impact, I think, is a far more interesting thing to focus on, because interest rates moving actually change how business is done and how a business will perform over a period of time. And I think that's the most interesting part for the portfolio, because essentially, if you're investing in businesses that require capital, they're heavily capital intensive and they're not profitable, they're not, cash flow positive, that's the business that's going to suffer. So if you are invested in companies like I am, thankfully, that actually have what you would call incumbent businesses, well-established businesses that arguably over the last 4 or 5 years have been experiencing competitive erosion due to these companies that come into the market for a myriad of reasons, but low rates have been able to fund, their growth. How many companies over the last 5 years have you seen that just, have a negative net income, but can get funded year after year? Let's say like an Uber or something like that, or
I was going to say Uber.
Yeah, Uber's the one off the top of your head. That
Deliveroo jumps to mind for me as well.
I think in the UK, probably the finance sector is a good one to look at. So like if you're Lloyds Bank, you're like a bucket with holes getting drilled into it, in terms of Monzo, Revolut, Starling, all these digital banks that don't make any money and probably won't make any money for a long time, that come along and erode your market share, and you can't do anything about it because rates are at 0 or 1%. They can attract capital so easily, focus on the growth, which is a great thing for consumers, etc. But when this environment switches, you then end up with these decisions where these companies have to turn around and say, look, we're going to have to focus on cash flow and profitability now because we can't get debt at 1%. They might have to go out to the bond market and do what 888 did and get an 11%, bond, which is impossible to then make work for your company. So cost of capital matters in terms of a company being able to go out and compete against you, a loss-making company. And one portfolio company I have here that, I've seen the tangible impact, and we can kind of go on to talk about other things about it, but the impact for interest rates is really clear, is PayPal. So if you're to look at the transcripts from the earnings call for PayPal, you'll hear time after time what they're experiencing now is competitors are actually backing out against them where they would have tendered offers previously. So in payments, it's still a business that you have to agree, say, with a merchant, a rate that you're going to give. So if let's say you've got a Shopify store or you've got an online store off of Wix or something like that, and you want a payment button to sell your hats and scarves, right? You could get an offer from 3 or 4 different payment providers. In the past, when interest rates were at rock bottom, you might have offers from the new upstart payment companies that are, operating for free money, basically. They might offer you, 0.2% on a transaction, whereas PayPal will come in at much higher rate because it needs the cash flow. Now, these companies that are operating at way thin margins are backing out. And so it makes, those transactions and competing against them a lot easier if you already have that kind of wheels turning where you've already got a well-capitalized business. So I think that's, an important part. I'm into the one story that I'm interested in following up on with that is actually Tesla, because I think that's a company that has pretty much benefited the most from zero interest rates over the last decade. You've got a highly capital intensive business of building these gigafactories and, just the amount of capital that's required. And Elon did it all at pretty much, the zero interest rate period, right? Or, between 0 and 3. So he sucked all this capital up to build this and, become the incumbent electric vehicle provider. And then you've got, the small upstarts like Rivian, Fisker, there's a Volvo one that's just listed. So you've got these ones that aren't profitable yet. And, if you look at their stocks, for instance, for Rivian's just, crashed 80%. So you've got businesses that are really shaky and don't know whether they're going to make it in terms of being able to attract that capital. So you're going to have probably a better competitive environment there. So that's just sort of the things that I'm thinking about when I'm looking at a portfolio as to how rates are going to really impact the business rather than the stock price over the short term.
So going back to PayPal, which is your biggest holding, if the current environment is actually more beneficial to PayPal, why has the stock performed so poorly? So this is one where we actually looked at it a few weeks ago on the show, and we couldn't believe how cheap it was for the quality of that business. And what do you think the valuation and quality is compared to Visa and MasterCard, who are probably the two closest competitors?
Yeah, so essentially, I believe PayPal succumbed to what's called the price drives narrative, right? So this was the best company in the world when it traded at $400 a share, and it's doing 5% every day, and you're just seeing, everyone loving the company. And then a couple of things go wrong, and the shares are on the decline, and the narrative changes. And I think the stock overshot massively, but I think it's done the same, on the decline. I think as a business, there are a few things that have happened in the recent times that just goes to show how much people almost detest the company because of the narrative, right? And the biggest one that I've seen no coverage on is the situation with Apple. So I think a major factor for me in adoption of PayPal's kind of services is whether or not they're on Apple Pay. It stopped me from using PayPal more than I would like to. And it probably stopped a lot of other people that essentially you get to a till in the UK or the US and you can't pay with your Apple Pay wallet. And that's because obviously Apple holds the keys to that wallet and for competitive reasons doesn't want PayPal on there. Now, there's been a lawsuit in the US and some sort of antitrust lawsuit going on. And actually, Apple have now turned around before that lawsuit is concluded and decided to work with PayPal on introducing their services into Apple Pay. And so if you look at their latest quarter, I think Q3, they've actually put that in their investor presentation. On one of the key slides up front, they put straight away, PayPal goes into Apple Pay. So that will be working in America. And I think that's going to do a lot of transformative things for the business. But then behind that, you've also got some other things going on, which is, as you probably know, the company's changed strategy. So it's not focusing on at any cost growth in PayPal members. It's just focusing on actually monetizing the existing 400 million plus people that's already there. But actually, as you look at that number, it's still rising year on year. It's got a business ex eBay, which is growing very well. And then the two other businesses within PayPal I actually really like. So you've got Venmo, which is a peer-to-peer payments company in the US, which has got something like 80 million users and is, pretty much outstripping a lot of the competition. But even in the UK, there's a company that they've got called Zettle, which if you go to many either market stalls or even, shops throughout the high street, you'll see that they'll use a Zettle terminal and the Zettle, paypad. So I think they're quite nicely spread across the payments ecosystem, and the margins speak for themselves. You've got a business doing 20 to 25% operating margins and can quite comfortably grow top line at double digits, free cash flow of something like 5 billion a year. So it's in the right spot to do some good buybacks with the price very low. So I don't think this is a business that's going away. I think this is a business that's getting better, and you don't sell businesses that are getting better despite the shares not being where you want them to be. On your question of comparing it to Visa and MasterCard, so I actually own MasterCard, not as high a position, and I think MasterCard and Visa are undoubtedly better businesses, but have come with a higher valuation than PayPal. So if you were to ask 2 years ago, I think PayPal was trading at about 50 or 45 to 50 times earnings, where MasterCard and Visa are about 30. But now I think PayPal's probably sub 20 times earnings, and you've got MasterCard and Visa, which have stayed at around 30. So, that's why it's become a bigger percentage of my portfolio, because of that, dip in valuation. But I certainly like the former two that you mentioned there as well.
So have you added to PayPal at all since it's dropped?
Yes. Yeah, I've probably doubled the size of the position.
What do you think of JD Sports? Because that's another one in your portfolio. I think it was there last time as well.
Yeah.
My issue, we've only covered this a couple of times on the show. The issue I have with JD Sports, I just think the JD brand here, it's a very powerful brand. I remember, for me, the classic examples I remember in year 8, year 9. If you went to school with a JD Sports bag, the yellow bag, it's a cool bag. It was cool. Whereas compare that to going in with a Sports Direct bag, you just wouldn't dream of it. But in America, these businesses they're buying, so like Shoe Palace and whatever, are these businesses as good, or are they diluting the quality of that brand? And that's my biggest concern with JD. That although I know JD and I like JD, I don't know the businesses they're buying. So what do you think about that?
Yeah, I think that's a good question. I think in the industry that they're in, you have to have this heightened understanding of the customer. Otherwise, you quickly lose share to whoever's the cool kid on the block, right? And you can tell that if you go traveling throughout Europe, you'll see the stores that JD owns and the ones that they don't own, and you can almost see. You go in somewhere, you can see what's a good store and what's a store that's not, appealing to that customer subset. And 9 times out of 10, JD get it pretty well on. There's a formula for doing this that, they've obviously done in the UK, but this is a company that's, had a lot of success outside the UK in Europe with their various brands. So in Europe, they own Intersport and a bunch of other. They own 40 shops under the Cosmos brand in Greece and others. So I've actually traveled around and gone into some of these stores, and what they'll often do is, if they're in a market where there's a store that has this connection with consumers because it's built up a cool brand or whatever, they will leave it, as it is. And I think they've done that in the US with DTLR and Shoe Palace, at least, because they're 2 franchises that are on the east and west coast. So, they've identified that if you actually read into the acquisitions, each store has a different subset of customers. So I think one of them on the west coast appeals to the Latin American customer base, which is, you've got a lot of Latin Americans in those kind of cities like LA. And then the one on the East Coast is a different consumer, completely. But they've done an acquisition called Finish Line, which was their first entry into the US. And they've actually set about changing a lot of those stores to the JD brand where they feel it's necessary. So I think if you actually look at the company and what they've done over the years and everything that they do, they are experts in creating this sense of a place to be and, really knowing their customer and understanding who they are, why they're buying what they're buying, and everything around it. If you actually look on the shop, the stores online for the companies that they've acquired, they've got completely different stock lines. So what's available in Shoe Palace and what's available in the DTLR store is completely different and often unique to that sort of specific site or area. So I think they'll probably hold on to those, individual brands and not merge them to the JD brand. But I think they're under control. I think the only thing that has changed with JD since we last spoke about it is the fact that their CEO and chairman, a guy called Peter Cowgill, has resigned. Essentially, he was dealing with a lot of pressure from the CMA in the UK, where, for rightly or wrongly, they tried to acquire Foot Asylum, which was around £100 million compared to their market cap of about 6 billion. And, you only have to take one look at Foot Asylum on the high street to know that they're going to go bust in a few years. They've got no customer proposition. It's, watery thin. And they've obviously, JD have just thought of it a way as to kind of buy some more real estate and slap the JD name on it, I guess. But the Competitions Authority blocked the deal. And then Peter Cowgill was since seen in a car park in his car next to, I think, the then CEO of Foot Asylum, in another car, and it all looked very dodgy. And so he hit the papers for that. And I think, you're not supposed to technically be the chairman and CEO in the UK under various rules, which you probably know more than me about. But all of that pressure mounted on him meant that he exited the business. So he was the kind of main driving force of that company for probably 20 years and built it into, one of the most successful companies on the London stock market over that time under his strategy. So I'm hoping that carries through, but that's probably the main one that I'm monitoring. What you do have with JD is it's predominantly owned by one shareholder called the Pentland Group, and they own various other companies, but their main investment has been JD, and they've just grown, as a investment vehicle behind that. I think they're private equity, and they own about 50% of JD. So you'd like to think that they've kind of got a good play in what goes on and where the strategy of the group goes over time. But yeah, that's probably my only concern. But I think in general, it's probably a good enough company to carry on holding.
Moves on quite nicely then to a business that I'm sure you probably have more than one or two concerns about, albeit a very good business. Boohoo and the current issues. What do you think of Boohoo? And do you see those issues as temporary? Again, I'm biased. I own Boohoo. John also owns it. Whenever we go through the reports and we look at the issues they're having, to us, they seem like temporary issues, without leading the question too much.
Temporary for the last 3 years.
That's temporary.
Yeah, I think Boohoo clearly do something amazing in their investor relations, because they clearly make it a little bit difficult to understand, really what's going on. I think I used to read, I used to have access and read some broker notes on them years and years and years ago when they were trading at a valuation of 60 times earnings, and this was the best business that you could buy in the UK at the time and all that sort of rubbish. So I think that, they clearly are doing good things on the investor relations side that I worry clouds the actual narrative as to what the company is doing. So there's that background. I've I'd say I've lost a bit of faith with it as a company. I think one of the things that I used to think about a lot more than I do now is around ethics. And I think we had this conversation last time that when you look at Boohoo, once you see a pattern of ethical missteps, you can almost be pretty sure that sort of stuff carries on happening. I think the last time we were talking about, the factory concerns that actually, funnily enough, are still ongoing. But the factory concerns, and then the other one that I said to you is the chairman Mamani. He did a building wherever he lives, and he just basically built a building without planning permission. And so you're building this picture of someone who clearly isn't playing by the rules, and you wonder about the ethical governance in that company. And actually over time that played out with all of the things that then went to happen, and you had a potential US lawsuit where they were looking at getting banned from the US. So there are so many issues with it as a company, which is essentially why, the shares have been battered. But, rather than looking at what's happened, what are you left with today? You are left with, a business that's got a very good business in the UK. You can look at the numbers; they're growing pretty well in the UK alone, but is hampered by essentially a weak margin, inflation, shipping costs. They've just basically expanded at the wrong time and hit a bit of a air pocket, should we call it, where they've chosen to set up all their US and overseas infrastructure at the time where you've got coming out of COVID. I mean, I read something about them flying planes. We were talking about capital allocation earlier. You're looking at a company that's flying planes of cargo planes of Boohoo t-shirts. That can't be very profitable. So, there are questions there, but they've essentially run into a supply chain nightmare at the wrong time. And I think, where you've got a company like Games Workshop that, the margin on their plastic is 30-40%. They've got a lot more leverage than a t-shirt where the margin is 4%. So, that's an immediate lesson. But, sort of scouring the wreckage, do you have a good enough company to hold on to? Probably. Would I be adding? I'd have to see some kind of real business turnaround and a return to much better profitability before I started adding. So that's my view, but I'm happy to hear yours.
Have you added to it since we last spoke?
No.
Oh, no. So when we last spoke, I didn't have it, and neither did John. It's only covering it on the show. We knew there were.
You into it.
Yeah, well, not just you, but covering it on the normal show a few times.
Yeah.
For us, the numbers it was putting up were always very good. And we always it was a bit like Fever Tree, where it was one of them companies, we'd cover it and be like, fantastic company, but it's just, for us, it was the valuation. When it was at 50 times earnings, we just couldn't justify that. And had it got to about, I don't know, like 20, 15 times earnings, and these are probably on reduced earnings as well. And at that point, we started thinking, well, actually, we do like the business. I don't want to speak for John, but I think of the problems are temporary. It's like, when they're talking in the reports about how like they just, they can't even satisfy the demand they've got in America. Think about how they're getting possibly to a saturation point in the UK, but that American market is massive. And I don't think it's really priced in because it's just so unbelievably cheap now. I know they have. I mean, I was talking to John I think it was last night when we recorded, it was off air, he was saying that there's been some kind of, I can't remember which paper, but someone's published some kind of sting on them again. And the latest issue is that in the heat of the summer in one of the factories, it was just insanely hot. And their solution was to put the Pakistani workers at one end where it was the hottest, and then the British workers were at the other end. And with the justification, and this is all alleged, by the way, but the justification being that they're more used to the heat, so they can deal with it. I won't go into the detail. It gets worse actually, but that's the latest thing. Fortunately, I think the shares have been battered so much it's not going to make any difference. But,
yeah.
So I got into it probably at about 60p, and I thought, well, this is pretty cheap now. It got cut in half. Oh no, was it? It might have been higher. It might have been like £1. I'm not sure. I think it might have been £1, £1.20 when I first got in. I was like, well, how much cheaper can it go? And I think it dropped to about 60p, and then I added again. I think I added again around 35, 40p. And it's at the point, it's not a huge position for me anyway, especially given that the first investors down like 75%. That's on a business that was already down 75%. But I'm quite happy. I'm quite happy holding it. I know it's very high risk, but I just think if they can get back to the sort of levels they were at, well, they don't even have to get back to those levels. I think they're so cheap now that if they just start doing okay, I think it's underpriced. And if they start to show some decent growth in America, I think maybe we'll not see £4 a share again anytime soon, or £3 or whatever it was. But I don't see why, if they can't start showing some American growth, and they're back to profitability in the UK, I don't see why it couldn't be a lot higher than it is. Because I view it as I almost think it's priced as if it's going to go bust. And when I look at it and compare it to, say, for example, Ted Baker, which we have looked at a few times on the show, we've looked at Ted Baker and we thought, well, it's priced as if it's going bust, because it probably is. I just don't get that with Boohoo.
Yeah, no, I get you. I think I suffer from, on this one, I was talking about price drive narrative earlier. I think I suffer from just being so underwater with that position, and just, you kind of go in that write-off mode where you don't want to hear any more about it. So, I'm not as up to date on the American story as I'd like to be. So I'll recap on that. But it's definitely an interesting story.
Well, in fairness, with the American story, there's not been much there because of COVID. I mean, the revenue compared to Europe, I think it's about a third of the size or something. It might be even smaller. But it's just with that market being so big. But obviously over the pandemic, they've just not been able to get the stuff there. So you've not seen that growth. And what I'm hoping is in the next 2-3 years, now that we're coming out of the pandemic, and I think the supply chain issues are being solved, I'm hoping to see the same sort of growth numbers we were used to, those 20-25% plus a year, but it's going to be America driving it rather than Europe. That's what I'm hoping to see from it. I could be wrong, but we'll see. So seeing as I did sort of mention it as a comparator, and I think it was only in terms of how it was one of the AIM darlings and it's had this big drop. I don't think it's fair to compare the current state of the business to Boohoo. But what do you think of Fever Tree's recent performance and the results? And last time you were on, you did talk about, there not really being a premium market in the US. And if they could create that, they could do very, very well. Do you feel like they're much closer to that?
Yeah, I think it's interesting in your comparison to Boohoo, because the story isn't that far away, in so much as the fact they're doing the US expansion at exactly the same time. So they've run into a lot of similar problems that Boohoo have. Fever Tree have a distribution partner out in the US called Southern Glazers, I think, something like that. They're the biggest US spirits and drinks distributor, and they've got a bottling plant out there. But essentially during COVID, they couldn't bottle enough of the stuff. We got workers going off sick, and people just deciding not that they don't want to do that anymore. So you've literally got, to pardon the pun, a supply chain bottleneck, on that bottling line, and you've got a shortage of glass. You've got things like that. That again, these are seriously short-term things. So what they ended up doing was piling a load of Fever Tree soda onto cargo ships and shipping it over to the US, which completely destroyed the margin. So that is similar to what Boohoo's doing with flying the stuff over, and I can see why they've done that. But with Fever-Tree, there's an investor that I follow called Nick Train from Lindsell Train. You've probably heard of him, but he's grown his position in Fever-Tree to be the number one shareholder over the last year or so as the shares have declined. So you've got Nick Train from Lindsell Train, and then you've got Fundsmith in the top 10 as well. So, this is a business that you've got some really good investors starting to kind of take a holding in. But what Nick Train was saying, and I agree with him, that when you are building a brand like Fever-Tree, I think Boohoo's a little bit different because it's less brand recognition than Fever-Tree is. You want to build, the next Coca-Cola, essentially, or like a niche version. So you're building this Fever-Tree brand, as they have done in the UK. It does not make sense to be spending on marketing and trying to grow the foundation in the US and then have the shelves empty. It doesn't make sense. So you should literally destroy your margin, get that soda on the shelf, hit the Americans with the marketing on all the channels you can, and then they go down to Target, they go down to Walmart or Costco and pick up as much of that stuff as possible and start drinking it at home, and then they can taste the difference between that and the sugary Schweppes that they're used to drinking, and you start to change the consumer mindset and do what we've done in the UK. Whereas I don't know whether I said this on the last time, but where I bought Fever-Tree was I was out with some friends, and they said, as they'd go to a bar, "Do you have Fever-Tree? I'll have a gin and tonic." If the bar wasn't stocking the Fever-Tree, they weren't going to have a gin and tonic, which essentially, is a signal to, one, the quality of the drink, but, the branding and the marketing that's gone in there, that, that is going to make their decision for them. So if we can get there with the brand in the US, which there are some signs that it's starting to, make some traction, Fever-Tree's got a massive runway. And I think that story hasn't really changed at all. All you've had is the impacts of the supply chain situation, and you're seeing shipping rates come down. You're seeing, workers return. You're seeing less, logistics problems. So, I think Fever-Tree's going to improve, and I think you're looking at a company that has been battered and can easily swing, back up, because at the end of the day, its margins are pretty decent. If it can just bottle enough of it in the US and wherever it needs to, I think that'll turn around.
What's the valuation like at the minute, and have you added to this one as it's come down?
Yeah, I added to it a couple of months ago, actually. Do you know what? I haven't checked, but I would assume it's something like around the 20 times earnings.
Oh, I was hoping you'd give it a look. I think we covered it about 3 months ago. And it'd come down to it was low 20s, maybe about 20.
Yeah.
And we were both at the point where we've covered it a few times, and really, as we've gotten to understand the business, we have grown to really like it. And it's a business that certainly I would like to own at a price, but I don't know, at 20 times earnings, I don't know if it's quite there. I appreciate there might be reduced earnings as well, but it's kind of, I think my mentality when we last looked at it like 3 months ago was, well, hopefully next time we cover it, it's been cut in half again, and then I'd have a serious look. So that's where I am with it. I think at a price, I would like to own it. So
if you look at the chart, and I'm on market screen here, I don't get paid for recommending them, but I sincerely would say go and use it. But essentially, in 2017, their operating margin was 27.7%. In their latest, results, the forecast for 2022 is going to be 8.7%. So you've had an extreme hit to the margins, and then that's obviously going to flow to net income and earnings, right? So their revenue has gone from, in that same period, 2019, is 261 million to, in 2022, it'll be around 358 million. So forecast of 400 million of revenue in 2023. So if you apply the same net margin to 2023, which is around 20%, you're looking at 80 million of net income versus 25 of net income, which is forecast for 2022. So, that PE of 25 could really, significantly swing the other way if they get a return to profitability. So I think it's probably cheaper than it seems.
Yeah, I think when it's a reduced earnings as well, you have to take that into consideration. Yeah. We've got SafeStore as a new investment. How long have you had this, and what led to you getting it, and what did you think of it? Did you look at any of the competitors? Because I think we've covered SafeStore and Big Yellow on the show. So what led to you deciding to pull the trigger on this one?
Yeah, so SafeStore was really came about as you know, I've changed jobs recently, so in terms of personal income has improved and cash flows improved. So on a personal level, I'm then able to kind of invest a lot more, over time than I was. So I think my focus has changed a tiny bit from, needing to ensure that my portfolio has almost like these kind of platforms or pillars for growth, because we all know that there's some companies in our portfolio that we look at and we think, okay, I'm only going to add a certain amount to that. If your salary went 5x, what are you going to carry on, adding in value, if that makes sense, because there's some things that you look at and you're like, okay, I'm only comfortable with a certain nominal value being attached to that name in your portfolio. Maybe I'm, not speaking investment sense here, but, for me, there's a certain risk, quotient with certain holdings. So SafeStore was added as something that, I wanted to beef up that ability to look at the portfolios. Okay, right, as I'm adding more to it, what are some of the names in there that I can look at and go, okay, I'm just going to continually add to these names because I feel the risk reward is good enough. And so SafeStore's a business that owns property in both London and Paris mainly. So you're looking at prime sort of real estate that it then, lets out to people who need temporary, storage facilities. So actually, when you look at the investor presentation, you've still got people from 2010, and beyond that are still, paid members of a site. And there's a really interesting piece on Costco, and you can find it on the Investors Chronicle, but Phil Oakley used to talk about Costco a lot on the Investors Chronicle. And I think that they'll have a slide in the Costco investor presentation that really looks at, once you've built a Costco warehouse, how that warehouse performs year after year. And what they've noticed that pretty much you build a Costco warehouse and its financial performance gets better and better and better every year in perpetuity. It attracts more customers, its net margin, improves. So you end up with this cycle of you build something and it, continuously improves. Actually, when you look at SafeStore, it does a lot the same thing. So it will build a unit that starts out not very profitable, but over time, that unit quickly kind of gathers pace, attracts more customers. Maybe half of it will attract customers that stay there for a long period of time. So the occupancy rate improves. And so you've got this snowball effect of each unit becoming, a stronger contributor to net profit and cash flow over time. So it's an incredibly powerful model. You've got things like divorce, breakups, deaths in family, like these things happen all the time and create the situation where you might need storage, in somewhere like London where there's no storage available. So, it's quite recession resistant, you would say. You got the net asset value that will increase with time. So it's not only, a business, but it's also an asset play. So there's a lot of features, but all in all, it's kind of a good growth, but, a responsible level of risk. So it's something in the portfolio that you can just add to. It's a sleep at nighter.
So you long divorce.
Exactly.
Right. So another one we talked about last time was Darktrace. This is a business I've not really followed at all. So I still know very little about it apart from what you said on our interview, and then also what Luke Hallard said when I covered it. I might have mentioned it with him at the very least. So yeah, how's that been doing?
Short answer, volatile is the only thing you can ascribe to it. It's a company that shot up, I think, 200% after its IPO, and then down 60%, and then it's recently had a bid from Thoma Bravo, which is a US private equity company in the space, and that deal went through. So that whipsawed, from probably up 50% and down the same amount. So it's been a wild ride, but as a company, it's still doing pretty well. I think it's growing at like 40%, and then it's got two kind of main things that you need to look out for, which is the net retention rate and the gross churn rate, or the net churn rate, sorry. So the net retention rate is, okay, how much as an average set of customers will you spend next year on Darktrace's services? So in dollar terms, and that's, about 106%. So although some customers drop off, the average is, the net retention of customers is 106% in dollar terms. So that's pretty good. The best cybersecurity companies out there are CrowdStrike in the US and Zscaler. And this again goes back to what we were talking about earlier about the US and the transformative companies they have. If you look at Zscaler's net retention rate, in dollar terms, it's about 127%. So each customer is spending that same dollar and another 27 cents again on the next year. And it's kept that up for a long time. So you could see what a company can go on to do. So Darktrace isn't quite there yet, but it's improved that retention rate over time. Then gross net churn rate is the amount of customers that drop off, which for Darktrace is around 6% of customers. So I've got some friends that work in the cybersecurity space, and one of the people that I talk to regularly, their company is around 25% of customers are churning, which is very high, and they're quite, they're still quite a good cybersecurity firm. So I think there's some good numbers in there that seem to be improving every time I'm reading reports, or at least kind of leveling off. From as much research as that I can do, I think I'm quite happy with the business in terms of what it's achieving. It just needs to separate itself over time from some of the problems that have caused it trouble, such as the kind of ex-founder Mike Lynch, who's got a fraud case in the US for autonomy, and then some of the kind of worries around that. So the longer it can carry on performing and putting up some decent numbers, I think the more investors will be reassured and come back to the name, which is it's currently trading at such a wide discount to those kind of key players in the US. It's probably, I'd say, about 60% discounted on a enterprise value sort of ratio that between those companies, that there's a wide margin there to go at.
Final question: what is Samarkand, and how did you find it, and what do you like about it? Because when you sent over the list, I'd literally never heard of this one.
You'll have never have heard of it because it's not actually listed on the London Stock Exchange or any big exchange. It's actually on the Aquis exchange, which used to be called something else. The name might come to me in a bit, but essentially it's an alternative stock exchange in the UK that deals with a lot lower volume and a lot lower, market cap sizes. So you can list probably a lot cheaper, and sort of it's an alternative way to attract capital. You can still trade these shares through Hargreaves Lansdown, but I think you have to call them to end up buying it. So it's a little bit. What
happens when you want to sell?
I think you've got to call them again
and hope someone wants to buy them.
Yeah, exactly. So yeah, this is a very risky area of the market that cannot be advised to people to go and look at. But this company itself, looking through, I was actually introduced to them from PI World, which is an investor service. They do all sorts of interviews. They've got a really good resources section on their website where they talk to fund managers in the UK about what they're doing and their thoughts and stuff like that. So that's really good. But anyway, introduced to them on that. I think they did their earnings release through PI World. Essentially what they do is they deal with e-commerce in China. So they are a portal for brands in the West to essentially frictionlessly list their wares on Chinese commerce sites such as Bilibili, Taobao, Tmall. These are a lot of the Alibaba websites and a few of the new ones. Douyin, which is TikTok for China. So essentially they've got expertise in e-commerce for China, and they're essentially like a mini THG in the sense that you can kind of deliver the product to them and they'll fulfill it, and deal with the whole kind of life cycle. So they've got quite a few brands that have decided to kind of partner up with them. And they've also got a checkout service called Nomad Checkout, which is another part of their business, which we're hoping is going to turn into a sort of checkout payments, facilitator. So they've got a few of the kind of businesses in that area. So I thought it was quite an interesting company. I think doing a bit of due diligence, I really like the company a bit more because if you actually go on Google Maps and look at where their head office is, they're based out of a industrial unit somewhere in the outskirts of London, and the guy behind it, David, I don't know his surname, but the CEO, he's just a very humble guy, and you can kind of, as you look at the situation of where they are and what they're trying to do, you kind of get a good impression as to these are guys that aren't trying to waste money on a flashy office and have lots of expenses. They're just really focusing on the business. And, I think one day they'll probably build it to a certain scale and sell it to someone like THG, who will look to, expand their kind of fulfillment and, services into a market like China. So I think there's a lot of expertise there. It's just going to take time to be tapped and leveraged, but, it's a company that's going to be, issuing capital and, probably not going to be a successful holding for quite a long time. So it's not something I'm kind of going to lose any sleep or hold my breath on.
So that's the end of the questions. Do you own Gamma?
Yeah.
I don't know why I didn't put a question about it. It might have been because I didn't just want to use you to just get you to just talk about all the ones I own. It was just a bit of a lazy way of doing some research. Seeing as I've brought it up anyway, though, what do you think of Gamma's performance in the last 18 months? In terms of the results, I mean, speaking as a shareholder myself, in terms of the results, I've been pretty happy with them. I've been happy with the acquisitions. I didn't feel like, even at its heights, I didn't feel like the share price was that expensive. I still liked it at 25, 30 times earnings, but it's come down a lot. I think it's down about 2/3. So, I like it more now and I have added to it since it dropped. But what are your thoughts on it?
So it's actually one that I haven't done too much research on since I last wrote on it, which, that article will be on my website. Essentially, the last results that it put out, I don't think the market liked that much, but it was still like a kind of this is the trusty old Gamma. Like I read, they've got a broker called Progressive Equity, which do research reports on them. So check those out as a bit of research. It's almost like a broker note for free. So Progressive Equity do some good ones. So yeah, the last results looked as kind of business as usual. I think growth was about like 9% or something like that. And, margins remain pretty solid, which is, great to see. I think the thing that I'm looking out for is what they do with the cash, over the last few years. I think they've made, an acquisition a year basically since probably 2017, and of the 30-40 million size, and they've now got about 70 million of net cash. And so I'm kind of, every time they post an RNS or something like that, I'm rubbing my hands to sort of see what they come out and do. And it's been slightly, I don't want to say irritating, but it's been tentative watching them not deploy that capital yet, because that's what gets the snowball rolling. And it's I view it as a serial acquirer, something that grows through acquisitions, and I'm happy with that, because it's done them so well. So we want that to continue, but I'm hoping that their market is wide enough for them to do that. But then back to our conversation earlier about capital allocation, maybe they're just taking their time to do it right, which is no bad thing.
Okay, so that is the end of the questions now. Is there anything you'd like to add, or if not, just one more time, where can people find you?
Yeah, nothing else to add really. If you want to find me, if you've got any questions, reach out to me. I'm on Twitter. Sam follows me, and he's tweeted about my account this evening, which is the 23rd of the 11th. I'm under the Quality Compound if you can't find me. I have a website, an email that you can ping me through an email. So james@thequalitycompound.com. So yeah, feel free to ping me out a question. I haven't updated the portfolios on the website for a while, so that's on my to-do list. So you can kind of check that out and see all the companies that we talked about over the last couple of hours. So do take a visit if you want. But yeah, I think that's probably everything, Sam.
Okay, well, thank you very much for coming back on. Open invitation if you want to come back for 18 months again, please do feel free, because I do enjoy chatting to you. Just thanks again.
No, thank you.
Right, in that case, thank you very much for listening, and we will see you all next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.